Hi, folks. My name's Chris. I want to talk a little bit about the Great Lakes financials. You can get any company's financial reports through the SEC website, sec.gov. If you go to company filings, you can then put in a ticker symbol. In this case, it's GLUX for Great Lakes. Do that, and you'll get all kinds of filings. 10K are annual reports. That's pretty useful. Other useful reports are 10Q. That's the same thing, but a quarterly report instead of an annual report. A couple other things that are kind of interesting is 8K is anytime there's anything abnormal that would change the scope of the business, or if one of the officers does any kind of options execution, you'll get an 8K on that. So this is where you can find 10Ks, sec.gov, and look for the website. All right, let me pull up my little show here. All right, my name is Chris Dupin. I'm a flight instructor. I'm also an active duty officer and a F-15 weapon systems officer. And then for some reason, I decided to get my MBA as well. So this is some of the stuff I've learned from my MBA studies. Great Lakes Airlines, I think they're about to crash. Actually, I think they're about to be bank owned. So I'll walk through some of the financials. A couple important financial documents. The balance sheet. Balance sheet on a company starts from company day zero to some point in time. An income statement, as opposed to being the entire history of a company, that just represents one period. So for example, one fiscal year or one quarter. Also, we're going to look at the debt picture on Great Lakes because they included some of that data in their annual report. All right, so let's talk about the balance sheet first. So let me get into a little pen mode here. I didn't want that. Go back. Give me pointer. Pen. There we go. Okay. The whole idea behind the balance sheet is that in order to have equity in something, it's assets minus the liabilities equals your equity. For some reason, they basically move the L to the other side of the equation. So a balance sheet is all about assets equals liabilities plus equity. So what you see on this balance sheet here is here's all the assets, here's all the liabilities, and then here's all the equity. So they got almost $78 million in assets. They've all got almost $78 million in liabilities plus equity. All right, things that are current. Current assets or current liabilities. Those are things that the company expects to use in 1 year. All right, so let's walk through it. They've got basically 2 years worth of balance sheet. So you've got company day 0 to December 31st, 2012, and then company day 0 to December 31st, 2013. So you can see the year-on changes. So year-on changes, cash. Great Lakes has about $6.6 million in cash. They used to have almost $3 million, so they've got more cash. Accounts receivable, gone down slightly. Accounts receivable are money that you expect to get where you've had the transaction already. For Great Lakes, that's mostly essential air service payments from the federal government. A couple other places they get accounts receivable from is code share fares from United, for example. Inventory, that's stuff that you've got on the shelf that you're not going to use, like spare engines and spare parts would all count as inventory. You expect to use it within a year, but it's still got some value. And in fact, this $8.6 million, they secured some debt with those particular inventory. Some other stuff, prepaid expenses, that's like rent you pay ahead of time, deferred income taxes. So total assets, total current assets, they got up almost $27 million. So things that they're relatively liquid, $27 million. Other assets, so normal companies, you see this line called PPE, property, plant, and equipment. For airlines, it's just property and equipment because they generally don't have plants. So $125 million in flight equipment, that's airplanes. Other equipment, about $10 million, that's ground handling equipment, tractors, and that sort of thing. And then accumulated depreciation, about $87 million. So that's the value that has come off the airplanes. So if you do some quick math here, you got $125 million in airplanes minus about $87 million in depreciation. What does that leave you? 35, horrible at public math. So about theoretically, their airplanes are valued at about $37 million right now. All right, liabilities. Current liabilities, things that the company has to pay off this year. $24 million. Holy buckets, $24 million in the current portion of long-term debt, as opposed to $3.5 million in December 2012. So that massive debt spike right there. The other couple of things, accounts payable, accrued interest, no real change. But notice their debt has gone up significantly. They got $31.4 million in current debt. And then long-term debt, about another $7.8 million in long-term debt, giving them about $39 million total. Total debt, $39 million. All right, other stuff right here. This is all stock right there. Don't worry about this top line, this par, this 1 cent par value thing. You combine those two up, and there is, when this company was initially floated, it was floated for about $32 million is what they got out of it. Don't worry about what the market capitalization is today. These numbers here have nothing to do with what the stock is doing today. The answer is not $32 million. And notice those numbers didn't change, so they didn't float stock between 2012 and 2013. Nobody would have bought it anyway. And then finally, retained earnings. That's money that the company kept. So at some point they made profit and they just kept it. So a little bit less, down by about $500,000. Giving them a total asset picture. So remember, assets equals liabilities plus equity. About almost $78 million. Something else to look at. So this current stuff, current assets, things that they can use within a year. There's an idea called a current ratio or a quick ratio. Quick ratio, that examines the short-term liability of the company, the ability of the company to continue operations in the short term. And what that is that's current assets over current liabilities. And if you do the math here, you get 27 over about 31.4. That's about 0.8. So if this company were to be, no kidding, liquidated today and they get full market value for all their assets, everybody would get paid at 80 cents on the dollar. Not an ideal outcome, probably. And that's on the short term. All the long-term debt would go away. All the stock would disappear. Thanks, Windows. I don't care. So for me, in my view, a bankruptcy option is a very bad option. Not very bad, but a complete Chapter 7 dissolution of the company. It's not a great option for Great Lakes, or really for its debtors. Who cares about Great Lakes? It's the creditors that are concerned about what they're going to do next. All right, so let's look at the income statement. So unlike the balance sheet, the income statement is for a particular year. And what you've got up here is basically you've got all the revenues, operating revenue, and then you've got all the operating expenses. For other companies, sometimes you'll hear this called COGS, or cost of goods sold. So, for example, if you make shovels, this is the cost of the wood to go in handles and the steel to go in the blades. You make shovels. For airlines, it's people and fuel, mostly. So, if you look at operating revenue for the airline kind of went up in 2012 and then kind of descended down in 2013. Pretty significantly, actually. And then operating expenses did the same. But, and here's my point, here's why I think the airline will continue, why it will continue being a bank-owned airline, is that operating margin has always been positive. Even now, while they're struggling, they're still making about $4 million as operating margin. What's really killing them is their liabilities. So, like in 2012, they had operating margin was $9.4 million, but they took $5 million to pay off their debt. So with that, they left with $4.5 million, take some taxes out. This bottom line here, this is called net income, or return, or profit. All mean the same thing. Net income, profit, earnings, return, all the same thing. Now, take that over to 2013, positive operating margin, but their debt payments killed them. This company's not being killed on operations. Certainly operations could be leaned out. I think everybody agrees with that. But they're getting killed on their debt picture. This company is financed wrong. So as you look through, almost $8 million operating margin, take out $4.3 million for liability payments, you're left with negative $500,000. A little bit of income tax income tax they paid that got put back. The company over the year lost almost $500,000. That's the issue. The good thing is, go back to the balance sheet. They've got cash. They got $6.5 million of cash right now. All right, so let's look at their debt picture a little bit. So GB and Crystal have their primary debt on about $24 million on long-term debt. And basically what they've done is they've pushed out their debt into the future. So what they did as a result of some deals they made in April is they basically took the current portion, this $224 million, and here they took it off the books currently and they pushed it out to 14 and 15. So this company has to figure out how to pay for $4 million in 14 and about $20 million in 15. I think the $4 million thing will be close because they've got, if they do numbers close to what they did previously. So I think 2013, if they change nothing, 14 will look a lot the same, about $4 million interest bill, close to $4 million in profit, leaving them with nothing. What'll be really interesting is there's no way that this company can swallow a $20 million bill. And then these companies here, these companies are basically into Great Lakes for $24 million. So what I think is going to happen is I think these companies are going to end up owning Great Lakes. So you got an operating margin of about $4 million. So imagine a new balance sheet. Imagine a 2014 or 2015 balance sheet. Let's go 2015. These numbers are the same. Let's call it 120 million. Let's call operating revenue about 4 million. There'll be no liabilities. There'll be basically $24 million in equity. So that debt will turn to equity. So these companies will have invested $24 million to get $4 million per year. Do the math, man, that's about a 16% return on equity. That's a pretty damn good deal. That's why I think the banks are going to own this company. That's what I've got. My name's Chris. I love to fly airplanes on the weekend, and for some silly reason, I want to eventually manage them. Thanks for listening.